Good morning, good afternoon, good night. Welcome back to another schema Scalper video. Today we're going to be looking at the PM session Silver Bullet ICT. And this was on Friday, the 4th of August. For those of you who don't know, the 4th of August was the first Friday of the month, which means it's NFP release. And I didn't want to be in the markets for the whole day, so I just took the day off from trading. But this is my post-market review. So this is just my markups of if I was in the market, this is what I would have looked at and how I would have gone about it. Okay, so we've marked out the buy side liquidity, sell side liquidity of the lunch session. It's always what I do first. And then I've also marked out areas of liquidity below and above the lunch session. So if it broke below the sell side and it reversed to go up, I marked out areas of liquidity above. And then if it broke the buy side and the reversing came down, I marked areas below. And if it had continuations, I marked areas below and above for that as well. So getting into it, so just mark up horizontal line. So right there, make the sticker. That's the start of the Silver Bullet trading hour. And this is right before what happened was price went into a fair value gap, respected it. This is all on the 1 minute chart. Price went into a fair value gap, respected it, and then broke the sell side lunch session liquidity. So after liquidity was taken, I'm looking at the fair value gap that took it, the fair value gap before that, and the fair value gap that is made right after the one that's taken. You can see here, this one takes it, so that's more important than the ones that were before and the ones that are going to come after. Because this fair value gap took liquidity, I'm looking for a move into it and away from it, or invalidating it. And you can see here, if I use my mouse, and you can just look up here, the high of this candle, you can look up here, the high of this candle came in at 15452.2, and the next candle, so this is that will be creating the low of the fair value gap. The next candle's high came in at 15452.5, so there's a 0.3 point difference, but it did go into the fair value gap, so it went in but barely. The liquidity was taken, went to the fair value gap, broke that low, so this now becomes intermediate term high, even though that becomes intermediate term high, even though it didn't go in completely full the fair value gap, didn't even go into halfway, but it went into the fair value gap. So I'd consider that as now us looking at the continuation. And then to the left of it, I'm looking for any area where there was a reaction of the fair value gaps. So here they made a swing low inside fair value gap candle, and the low wasn't taken out, with the high taken out. That becomes an intermediate term swing low. So once that's broken, I know market structure now, or order flow would now be bearish. If I have the understanding that order flow is bearish, I'm looking for targets below marketplace, and the way we look for those targets are AM session liquidity, PM session liquidity, and lunch session liquidity. All of those are in the video of ICT one trade setup for life, I think that's the name of the video. Yeah. And in terms of entry, so now we know we are only looking for sells down to liquidity. In terms of entry, we're looking for a return into the first fair value gap. So I don't mean the first one as in the first one that starts the session. I mean the first one that it returns to. So if this never happened, all of this never happened, and there's actually a return, that now becomes intermediate swing high, intermediate term swing high, because that low was taken. I actually missed this. That's interesting, I missed this. Intermediate swing, intermediate term, so ITSL. Oh yeah, just refreshing the page because the Wi-Fi. Intermediate term swing high created in here by this candle. I actually missed that in doing the review, but now I see it, and I can actually now I'll leave my stop there. See, the market came back into this fair value gap and respected it, and I would have had my entry right there. And in terms of targets, once I'd seen this low been broken, I'd know, okay, now I can start setting real targets instead of just like, I look at it as plastic targets. So I'm just having a target down below old lows, or like here I would have had my target down here below this low, or below the lows that create sell side liquidity. So that's within the time that I just said, or within the ICT one trade setup for lifetime frames. I'd have had it there or below here, just depending on the time I also into the trade. And we've got, after it breaks that low, this now becomes an intermediate term high. I put my projection on that, and we get -1 standard deviation, 2 standard deviation, 3 standard deviation, 4, 5 standard deviation. And if you see, how that I understand it's bearish market structure, I'm just going to remove this because it's not very important. This is bearish market structure, and we're looking to take our position off below sell side liquidity. So this is the areas of sell side liquidity. Sell side liquidity for the 3rd of August, that's the AM session. So you see all the other standard deviations weren't outside the sell side liquidity. So it would be the 4 standard deviations and 5 standard deviations, which would be my 2 areas of targets, because this is sell side liquidity, and I'll show you guys. 3rd, 4th, 3rd. Just remove that. And these are the swing lows. This swing low, and that's marked as an extreme. This swing low marked as a normal. This swing low marked as a normal. And once it's broken the -1 standard deviation, or 1 standard deviation, I also saw that there was an inversion fair value gap right in here. 1 minute of fiction, inversion fair value gap. It was also respected. Oh, there's another gap inside there. It was also respected, so that becomes an intermediate term swing low, which ends up being broken. And you can see how the market, after breaking it, I'll just mark it out. Intermediate term swing low. After breaking it, acts as classical support and resistance. See, it goes, bounces, goes down, bounces off that exact point again. So yeah, then it went to 4 standard deviations, but I would have liked to see it take the extreme at 5 standard deviations. That would have been a trade of 23.5 points risk with a target of 128 points as a target. I hope you guys enjoyed this little market review. Everything that I'm saying here I actually implement in my actual trading, like live trading. If you guys haven't seen me live call the market, I have a video or two, I'm not sure. I think I have one video so far of me actually live reading and live executing. I don't show my executions yet, but soon I will. Cheers. Hope you guys have a good week. Enjoy the weekend. Study hard. Cheers.